Are we in a bubble? Stock markets have been hitting all-time highs in 2024 and now into 2025, and valuations are exceedingly stretched. Does this affect you? And are you taking more risk than you think you might otherwise be suspicious of? Stick around. We'll talk about that.
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
Our guest this week is George Athanassakos. He is the professor of finance and the Ben Graham Chair in Value Investing. He is also the founder and managing director of the Ben Graham Center for Value Investing at the Ivy Business School at Western University. George, welcome.
Thank you for inviting me. I'm glad to be here.
It's people watching at home will not know this, but we've had some challenges with technology today. And I'm just delighted to finally have you on, George. I've been a fan of your work and I've read many of your articles over the years. And I wanted to begin by asking you about value investing in 2025. You are one of the foremost proponents of value investing in Canada. And I'm curious to get your take on what you make of these Mag 7 stocks and the mania of growth investors these days.
Yeah, I'm not very comfortable to buy stocks that have stratospheric multiples. You know that, as value investors, that we don't like growth stocks. We do like growth stocks, but we don't want to overpay. And most people actually overpay for growth stocks. So if you look at all this Magnificent Seven you mentioned, the implied growth rates in these multiples and valuations, because the multiples are a function of the growth rate. So companies with high multiples have high expectations about growth. But for these 5 or 7 stocks, the projections of growth is 20% a year to infinity, forever. This cannot happen. Okay. Studies after studies show that companies cannot sustain an above average growth for a long time. So something always happens: competition, government regulation, and we know that the Department of Justice is trying to break up many of these companies, or taste change, and the growth rate eventually slows down to the average. So I don't want to buy something that has an implied growth rate of 20% forever.
Right.
You can buy the best company in the world. If you overpay, you're not going to make a lot of money. When the consensus goes after a stock, and when a stock like these stocks you mentioned are in the microscope, they get a lot of attention, and the attention makes the prices shoot up. I mean, I can quote you studies that looked at low growth stocks.
I think that's really what I wanted. I just wanted to get your sense from the beginning in terms of where you are right now. I was pretty sure what your answer was going to be. I'm wondering about maybe a quarter century ago and the turn of the millennium, we had a similar mania with regard to what's become known as the dot-com bubble. Does it feel like that now as well?
I mean, it does feel like this, because everywhere you look, it seems that all indicators show that markets are very highly priced. If you look at the Buffett indicator, which looks at the market cap over the GDP, over 200 times, which is the highest since 2000. The CAPE indicator of Shiller is again at the highest level since 2000. The S&P 500 PE is at the level where historically this led to a bubble burst. Right. Other telling features, I guess, of what's happening here: retail investors, who are the worst market timers, are jumping both feet in the stock market when the smart money is getting out. Like insiders are selling, corporate executives are selling. Buffett is accumulating $300 billion in cash, which also he did this in 2000.
Right.
Money market funds are exploding in growth. So we're in an environment where we've got this AI contagion, I think, is taking place and make people behave very irrationally. This excess optimism will not end well.
Right.
I mean, it is true that some of these companies have real cash flows, and you say maybe in 2000 did not have real cash flows. But again, these cash flows are concentrated in these 5 stocks. there's not much breadth in the market. Like 27% of market cap today is, and also if I extend the market cap in cash flows, because cash flows determine a market cap. So there's a very high concentration of cash flow for these few companies.
It's sure. And you mentioned Robert Schiller a moment ago, and his CAPE indicator, cyclically adjusted price earnings. It seems to me that what we're talking about is something that a phrase that he coined many years ago, which is called irrational exuberance. It seems to me, and I clearly agree with you. I think what we're dealing with right now is a mania where a lot of investors are not really even investing. They are rather speculating, and they are irrationally exuberant about what they might reasonably expect going forward.
Yeah, I mean, this term was used first by Alan Greenspan.
Yeah, but Greenspan was paraphrasing Schiller. Schiller had used it in testimony, and then Greenspan used it a week or two later.
So Schiller used it in his book in 2000. I thought, anyway, that's matter. Alan Greenspan, I thought he did before me.
Okay.
You are right.
Doesn't really matter who said it first. Let's talk about an article that you wrote a couple of weeks ago in the Globe and Mail, where you opined that investors are once again optimistic, driven primarily by an expectation of further interest rate cuts and the belief that AI will solve the world's productivity problems and lead to better living standards, higher GDP per person, and more highly valued companies. Is that optimism really realistic given what we've been talking about today?
Yeah, my feeling is there's too much optimism here. What drives interest rates? Inflation. So the question is, are we in an environment of low inflation or high inflation? I think you have to differentiate between cyclical inflation and secular inflation.
Right.
Even though over the business cycle you may get lower inflation, higher inflation, depending on the economy, I think there's a secular trend towards higher inflation. No matter how you look at it, you look at the globalization, you look at nearshoring, will companies be bringing production back to their own countries, high cost countries, and then the companies will pass on this to the consumer. So that's one big trend. The other is tariffs. It seems that if the U.S. start a tariff war, they're going to be reprisals. Okay, they're going to other countries going to start a tariff war, and Canadians also talk about having their own tariffs against the Americans. Then you got ESG. ESG fear prevent many companies from investing in exploration. So when demand for EV and renewable and so on starts to increase, there will not be enough supply and prices will go up. And then you have the fact that population growth and what happens there. In Germany, they're going to have 5 million fewer people by 2030. In the US, they're talking about deportation. Working countries have a shrinking workforce. As you have fewer and fewer people coming to the market, into the labor force, wages will go up.
With more retirees too, it's going to be more of a drain on social welfare system as well.
Too. And Bloomberg shows that wage growth in the small cap stocks in the US is an all-time high. And will this catch up with the large cap stocks? So I think inflation, the trend is up. And this will higher interest rates in the long run. And then you got other stuff that lead also to believe that we'll have higher interest rates. One is the record US debt. Second is the fact that many countries like Japan and China are selling US treasuries. Many global central banks are selling treasuries and buy gold. All this creates excess supply of bonds, lower price, high returns, high yields. And on top of this, the icing on the cake is that real interest rates trend is upwards as well, because there's an imbalance between demand and supply of long-term capital. The demand is huge because of AI, renewable, EV. The supply, with the baby boomers retiring now, they will not be saving anymore. They will be spending money, be saving. So the demand supply imbalance there, because I need to higher real interest rates. So high real interest rates, high inflation, there's no way to expect lower interest rates, okay? Right. Long term. They may come down and up, I guess, depending on the business cycle, but I think trend-wise, we're going to see in the long run higher interest rates. And then you got the AI optimism. I think, again, this is the markets are over optimistic about AI. We'll talk about productivity. Yes, maybe productivity will increase, but at this point, this is purely theoretical. We
Right.
know historically technologies have been disappointing in increased productivity.
Right.
Since 1980, we got huge technological advancement, but productivity has been going down for the last 40 years. And as Nobel Prize winner Solow said, that computer age was every good except for the productivity statistics.
Right.
So, so I think retail investors have become too euphoric, I guess,
Right.
about the benefits of lower interest rates and AI. And
So what I would say, George, is that I agree with you. If you look over my shoulder there, I wrote a book a couple of years ago called Bullshift, and the subtitle is How Optimism Bias Threatens Your Finances. And what I would say is that I agree completely with what you're saying, because this euphoria has gotten out of control and people have become complacent. And they just think that, well, if ever things get tough, what they learned in COVID, and this is a recency bias, I'll just say, well, the government will just step in and bail us out, and as a result, we don't really have to worry about fundamentals or valuations because we can do whatever we want because the government will help us. I wanted to go back to the article that you wrote in the Globe a couple of weeks ago, and I'm going to quote you directly here. So in that article, you said, and I quote, "This optimism has propelled the market into uncharted territory. The Buffett indicator is approaching 200%. In fact, it's over, which is well over what we saw in 2000 during the dot-com bubble. The S&P trailing price earnings ratio is in the fourth highest it's been in the last 124 years. The three previous peaks were in December of 2021, June of 1999, and June of 2021, just prior to the arrival of bear markets. And the CAPE indicator, which you've already mentioned, which uses real earnings per share over a 10-year period to smooth out fluctuations in corporate profits, also flashes red, with U.S. stocks at their most expensive since 2000. Market breadth is weak. The top 5 stocks in the S&P 500 accounting for 25% of the market capitalization, a near record, compared to only 18% of 2000. So I have long shared your concern. We are preaching to the choir. You and I are absolutely in agreement about pretty much everything with regard to valuations in terms of the actual things that are measurable. But I think also in terms of investor psychology, we share the same concern that people are just doing whatever they feel like doing because it's been paying off. Why do so people listen to people like you and me?
well, the question is why not people do the right thing? And it's a matter of human character weaknesses, human nature weaknesses. People are not, many psychologists have shown this, people are not rational.
Right.
Fear of missing out, greed, impatience, short-termism. They want to become rich fast, and they try to time the market, and timing the market doesn't work. Buffett started to make most of his money in his 60s. Okay, be patient and let the power of compounding work. Okay, but most people don't do this. Most people, they have difficulty making choices that require sacrificing short-term pleasure for long-term gain. Now, we do warn people, and I think there is a bubble. The problem with bubbles is that we know they are, but we don't know when they end.
Right.
So many times we sound like crying wolf because
Right.
we say bubble, but we don't see the end of the bubble. It will happen, and then it will not end well for many people.
Right. And that's part of my concern in my day job, in my advisory practice. I've been telling people that they should be worried about this for a very long time. I've actually been concerned about valuations going back to just before we heard the word COVID, sort of more like January of 2020. So I've been concerned about valuations, the CAPE ratio specifically, for about 5 years now. And notwithstanding a 5-week hiccup during COVID in February, March of 2020, and maybe 8 or 9 months in the rate hikes of 2022, we really haven't seen much by way of pullbacks despite these valuations. The saying that people like to use in the market is that markets can remain irrational longer than you can remain solvent. Now, I'm not insolvent. My clients are still finding other ways to make money because we're finding other things that are conservative but not really exposed to these high valuation stocks. But it's interesting that there are so many people that are piling in with valuations this high. I wanted to draw your attention or get your thoughts on an article that you just wrote very recently. On January 16th, you wrote an article about the January effect, and specifically how people are feeling optimistic in general, but also how the January effect isn't necessarily being played out this year the way it often plays out. Can you explain what you mean by that?
Or you have to ask yourself, I guess, what causes the January effect? And I think it's portfolio rebalancing by institutions. And they tend to, in January, they want to make the Christmas bonus. So they want to make sure they have high return and they beat the benchmarks to make the Christmas bonus. So in January, they try to take more risk than the benchmark and they believe high risk, high return. But they're not stupid. They don't do this all the time. They do this only if they believe the markets are going to be doing well or the economy is going to be doing well. So when we talk about January effect and we say January is strong, it's not always true. On average, it's strong. But when the economy is not doing well, we have a weak January effect. And when the economy is doing well, we have a good January effect. Normally, this is what happens. And whenever the yield curve is positive sloped, and whenever the earnings forecasts are increasing, we see a January effect because everybody's expecting better times. So this year, despite the fact that we see this positive effect for the historical January effect, we see so far negative January. And the question is why this may be happening. Could the smart money anticipate that this positive yield curve and higher earnings expectations are over optimistic? And throughout the course of the year, we're going to see higher interest rates, negative slope curve, lower expectations of earnings, and maybe a recession. Right. So that's why I think I titled "What's Wrong with the January Effect" this year.
And just for the people listening at home, what we're talking about, I guess I should have noted this at the beginning, is that historically, January is a good month for investors, and usually, if January is a good month, it portends a good calendar year to follow. One of the things that we didn't expressly say, but I wouldn't mind pointing out, is that a lot of portfolio managers will be aggressive, as you say, in January because they want to get higher returns when things are going well. But they window dress their portfolios so that by the end of December, they sell their growthy things to buy more conservative things, so that when you do your annual report and you show your holdings as of December 31st, people look at the performance and they go, wow, that was great performance. And they go, wow, these are nice conservative blue chip names. Wow, if I could get this performance with these names. What they don't realize is that performance was in these growthy stocks that managers sneakily got out of and repositioned the proceeds into more conservative things in December. And many investors who don't look under the hood and aren't paying close attention are oftentimes none the wiser with regard to the shell game that's being done with regard to performance and holdings.
This is what I said in the article, I guess.
Yeah. Yeah. And it's amazing. And so good. I just wanted to summarize for those who haven't read the article. I just wanted to cover that off. But the other thing that's interesting that people might not always think of is that in December, when markets are down, people do their tax loss selling. And when markets are up, people will oftentimes defer their selling until January because they don't have to pay taxes until April, 16 months later. But when you're talking about the January effect now, in a year where 2024 was very good, a lot of markets were up by over 20%. If you want to do the window dressing, you can do that, and you can fool people from a performance perspective and what seems to be a risk-adjusted return perspective. But it's going to cost you on a tax perspective because you're going to trigger some capital gains, and that tax bill is going to be due this coming April. So a lot of people, don't think about that when they make their decisions about what to buy and when to do it. Okay, enough about that. We've talked about these things, and I think we're in radical agreement. I want to wrap this up. George, the way I always end is by saying this is a podcast about making better wealth decisions. If you could offer advice to people at home, what advice would you give them to help them make better wealth decisions?
Well, I mean, at this point, given my view about the over-optimism, I think people should try to stay liquid. Should invest in good quality stocks, and especially good quality dividend-paying stocks. Should avoid sectors that are very high risk, and also stocks are very high risk. And should buy indices. Try to diversify through buying indices. Don't buy individual stocks because this thing may end up really badly. And buy indices because they diversify. And buy indices in in sectors that we need, I guess, for everyday living, like, healthcare and consumer products. The high tech, technology is here today, gone tomorrow, a lot of competition, a lot of disruption. I would really be very skeptical in this environment of high multiples. But
Thank you so much.
I want to, because you mentioned, and I think that's very important for your audience to listen, the view of Schiller, and I want to read the quote from the book.
Yeah.
He wrote in 2000. I read this quote, and you think it's now, okay? You think it's now. He says, irrational exuberance is the psychological basis of a speculative bubble. I define a speculative bubble as a situation in which news of price increases spurs investor enthusiasm, which spreads by psychological contagion from person to person, in the process amplifying stories that might justify the price increases and bringing in a larger and larger class of investors who, despite doubts about real value of an investment, this is what we tell them all the time, are drawn to it partly by envy of other successes and partly through godless excitement. End of quote.
Yeah,
okay,
exactly.
There's an AI contention now. There's a dot-com contention back in 2000. And I don't think we're well, okay? People, where the risk appetite contracts, then I don't see this ending very well.
It's funny because one of Schiller's next books was something called Narrative Economics, and he actually told that same sort of story through the lens of how people get it into their head that there's a story that this time is different, and then the story becomes it spreads like a contagion because they just get the sense that, oh, this time we're it's going to be different. There's not going to be a bubble. It's going to be a new reality of AI-led innovation, and trees will in fact grow to the sky and so forth when there's no rational reason to think that'll actually be the case. So thank you for your words of wisdom. I cannot say strongly enough that I agree with you. I hope people do listen and diversify into things that are less risky, and hopefully they can get through what I believe is coming in 2025. I don't want to predict, I don't want to forecast, but this has been going on for a long time, and I think we're at the point now where it just simply cannot go on much longer before what I believe is a bubble actually bursts.
And I cannot finish this without putting a plug on my book. I don't see my book back there in your stacks there. My book, Value Investing from Theory to Practice. It's an excellent book for people to understand the process of value investing and what I've been talking about in this interview as well as in other interviews.
Great. Thank you very much, George. I very much appreciate your time today.
You're welcome. Take care. Bye-bye.
John DeGooey is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdegooey@designedsecurities.ca.